The 10-year Treasury is sitting at 4.29% right now, and Wall Street is basically handing you a participation trophy for your money. But what if 3 overlooked REITs could quietly hand you $6,300 a year on roughly $98,000 without you ever fixing a leaky faucet or chasing down a tenant? We're talking about a blended yield north of 6%, which doesn't sound earth-shattering until you remember that the safe government bond is paying you less than a cup of fancy coffee per dollar invested. The gap between settling and winning here is literally the difference between your money working a regular 9-to-5 or pulling a double shift. The catalyst behind this whole conversation is simple. Interest rates have been high enough to make treasuries look attractive, lulling income investors into a false sense of security. But CPI-linked rents, institutional-grade tenants, and monthly dividend checks are a completely different animal than a coupon that just sits there aging like forgotten leftovers. Enter WP Carey, a diversified net lease giant with long, weighted average lease terms and rents that actually rise with inflation, like a landlord who remembered to put an escalator clause in the lease. Their occupancy is high, their recent acquisitions are expanding the portfolio, and that 5% yield is the kind of steady, growing income stream that laughs quietly at fixed-rate bonds every single quarter. Then there's LTC Properties, focused on seniors housing and skilled nursing, paying a 6.8% yield, and writing dividend checks every single month like clockwork for over 2 decades. They're actively shifting their portfolio toward higher margin seniors housing assets, which is basically them saying, we see the demographic wave coming and we're paddling toward it, not away. And then EPR Properties walks in the room with a 7.5% yield and a portfolio full of movie theaters, amusement parks, and entertainment venues, which, yes, sounds absolutely chaotic on paper, but their lease and operating occupancy is remarkably high. Their major tenants are institutional-grade operators, and they just raise their monthly dividend while going shopping for more amusement parks, like it's completely normal behavior. Now look, experiential real estate had its villain arc during the pandemic, and anyone who lived through the movie theaters are dead forever discourse of 2020 knows exactly how that narrative felt. The irony is that those same theaters and entertainment venues bounced back, and EPR kept paying, which is the kind of plot twist that separates the patient from the panicked. Here's the historical pattern worth respecting. REITs have cycled through fear and favor for decades, and the investors who collected income through the noise consistently outperformed those waiting for the perfect entry. Every single cycle feels uniquely terrifying, and every single cycle eventually reminds you that cash flow is the most boring and most powerful force in investing. The common misconception we need to kill right now is that high yield automatically means high risk. Sometimes it means the market is sleeping on a sector. Institutional investors own significant stakes across all 3 of these names, which means the so-called smart money already ran the numbers and liked what they saw. Allocating roughly $32,667 to each of these 3 REITs gets you to approximately $98,000 deployed across seniors, housing, net lease, commercial real estate, and experiential properties, 3 completely different economic exposures under one income strategy. Compare that to owning a rental property, where your liquidity is 0, your toilet is your problem, and your tenant's drama is now your drama. The practical lesson history keeps teaching is this: diversify across sectors, size your positions moderately, and let the dividend reinvestment or cash flow do the compounding work over time. Conviction is not a strategy process. Patience and position size are the actual edge, and anyone who tells you otherwise is selling something louder than their returns. There's something philosophically grounding about building a portfolio where $6,300 a year just arrives, whether markets are throwing a tantrum or celebrating a new all-time high. Discipline and consistency are the unsexy superpower that most investors intellectually respect and emotionally abandon. The second volatility shows up. And honestly, if rates fall and REITs re-rate higher, this strategy wins on price appreciation too. And if rates stay elevated and these dividends keep flowing, you're still winning on income. Being comfortable with either outcome isn't passive resignation. It's the rational preparation of someone who built their position with eyes open. The beautiful absurdity here is that the market is essentially offering you inflation-linked, institutionally owned, monthly income-generating real estate portfolios for less drama than owning a single duplex in a city where permits take 6 months. You don't need a contractor, a property manager, or a therapist, just a brokerage account and a little patience. Whether you want help building a portfolio like this, investing in physical real estate, finding contractors for your next project, or connecting with lenders who can make it happen, check out our links in the description below.